StephenDKing, When the Money Runs Out, The End of Western Affluence. Embark on a revealing exploration of Western economy's turbulent pasts and the dangerous delusions that rose to the forefront in StephenDKing's When the Money Runs Out, The End of Western Affluence. This insightful summary offers an in-depth comparison between the recent financial crisis and the Great Depression, revealing the patterns of hubris and nemesis that shaped these historical events. Delve into the intricacies of government policies, fiscal positions, and monetary actions, while evaluating the effectiveness and potential perils of these strategies. Gain an understanding of the role quantitative easing plays in our economic landscape and the challenges faced by different societal groups. Prepare to be informed, enlightened, and perhaps even cautionary as you navigate the economic storm that continues to buffet Western affluence.
The Delusions of the American Property Boom. The pre-2008 American property boom was a classic example of hubris. Economists failed to realize the seriousness of the subprime crisis, causing a catastrophic credit expansion that led to illusory prosperity. The government's favorable recording of risky activity in GDP figures further encouraged subprime risk, which eventually resulted in the inevitable hangover. Stagnation removes opportunities for economic growth and makes it difficult to distribute its benefits. The book highlights the similarities between the recent financial crisis and the Great Depression, both of which were caused by low interest rates and a binge on easy credit. The gap between the risk-free interest rate and higher interest rates for uncertain ventures creates a reward for risk-taking, which contributed more to the GDP's banking services component before the crisis. Lehman Brothers and Bear Stearns were star performers in GDP creation during the run-up to the crisis. This book argues that we need to avoid the collective delusion of recurring bubbles in Western economies and learn from the mistakes of the past. FDR's policies and today's crisis. The legacy of President Franklin Delano Roosevelt's policies during the 1930s is often brought up in discussions about the current crisis. However, crucial differences set them apart. One of the key differences is the nominal dollar value of the economy. During Roosevelt's time, the nominal dollar value of national income dropped 50%, while in 2012, 4 years after Lehman Brothers' collapse, it was already almost 10% higher. Another difference is the government's fiscal position. When Roosevelt was president, the shortfall between government receipts and spending peaked at 9%, and America had already reached that deficit rate by 2012. Finally, public sector debt was around 38% of national income in 1934, while by 2012, it was more than 100%. Observers shouldn't mistake stagnation and disappointing statistics for all-out deflation and depression. Besides, persistently low interest rates are a sign of lasting economic failure, not a harbinger of future economic success. Even though the U.S. government has exercised stimulus, it has gone much further than Franklin Delano Roosevelt's policies in the past. The controversy of quantitative easing. The government's implementation of quantitative easing, QE, has made central bankers more politically controversial. The policy aimed to reinvigorate the economy but resulted in higher prices for commodities and assets, financial repression, and a corroding anchor for all asset values. QE has also caused low yields on U.S. Treasury bills, leading to a downgrade from Standard & Poor's. While low rates help fund national debt more cheaply, pensioners and investors suffer, and big blue-chip companies can easily raise funds despite not needing extra money. Although QE seeks to stimulate results, it fails to incite ordinary economic growth. Cracks of modern economies. The economic crisis has exposed serious schisms in modern economies which fall into three broad types: intergenerational, haves and have-nots, and creditors and debtors. While healthy rates of growth can paper over these cracks, difficult times have brought more fighting over the spoils. The new money created by QE boosted stock markets, benefiting the already rich at the expense of low-paying new jobs for wage earners. This has revealed a contrast in fortunes between wage earners and the rich, who own the majority of shares. As unconventional policies have become increasingly conventional, the separation of monetary church from fiscal state no longer holds. Further, the high inflation that baby boomers enjoyed when they were younger helped pay their mortgages, but now boomers want low inflation to protect their retirement, and younger people see their standard of living falling. Meanwhile, high levels of indebtedness to foreigners put future national assets at risk. The schisms in rich countries show that everyone can be on the make and on the take, and hitting an inflation target when the economy is on the ropes is a bit like taking pleasure in one's exercise regime even as the cardiologist tells you that you need a heart transplant. International debt and its consequences. The 2008 financial crisis had an international dimension, revealing the massive lending between Northern and Southern Europe and China's large purchase of U.S. Treasury bills. To favor the U.S. electorate, actions such as debasing the national currency or bond yields are taken, causing foreign investors to purchase real assets like London property or American brands, putting the younger generation at a disadvantage. The danger of addiction. The book discusses the potential drawbacks of relying on policies like quantitative easing, QE, and the importance of rapid adjustments for economic growth. Countries with control over their currency can print money and lower their currency's exchange value to avoid the full pain of downward income adjustment. However, during the late 1990s Asian crisis, countries without these privileges couldn't stimulate their economy due to low international confidence. The book argues that a medium-term commitment to an acceptable growth rate for nominal GDP is more important than an inflation target. The West's culture of entitlements and expectations can lead to a lack of quick adjustment and reform, which endangers long-term assets. In contrast, post-crisis Asian economies bounced back in style. The book warns of the politicization of global capital flows and suggests that having fewer options might ultimately be more desirable. Escaping the debt trap. Western governments missed their chance to run surpluses and pay off loans during good times. Now they are addicted to stimulus policies despite increasing liabilities. To avoid being at the mercy of domestic debtors, nations must pay down debt systematically. This can be achieved by mandating debt repayment each year, with automatic circuit breakers in times of economic weakness. This tactic echoes the stabilizing effect of federal benefit payments and tax collections on the larger economy and its cycles. This will reduce booms and recessions, preventing Western governments from slipping further into debt. The dangers of deflation. Inflation has long been the enemy of central banks, but in today's world, deflation is the real threat. High debt levels mean that all debts act like a collective vice, and a lack of inflation makes them unbearable. A predictable amount of normal inflation is the next best way to make debts bearable, avoiding the chaos of patchy defaults and bankruptcies. The policy drugs dispensed by central bankers are more addictive painkillers than cures. While stronger growth in the near future may change the situation, deflation must be treated with caution. Targeting nominal GDP. The relevance of nominal GDP in fiscal policy, businesses, banks, and individuals' perspective is highlighted in this book. The central bankers must estimate how much inflation to push into the system based on the shortfall in economic growth to stabilize the rate of growth of nominal activity. This policy could have produced a more favorable outcome in the run-up to the 2008 crisis. A nominal GDP targeting policy would have aimed for lower inflation when growth was healthy, limiting the loose credit environment, and reducing the extravagances of the subprime episode. Steady nominal GDP growth, whether by real growth or by inflation, would provide a remedy for today's economic malaise and improve business confidence. The author believes that by targeting nominal GDP, representing the value, and not the volume, of economic activity, central banks can prevent all commercial banks from engaging in risky ventures, stopping the lemming-like behavior that might otherwise end in tears. The author suggests that authorities should frame this policy as a medium-term ambition and estimate values accurately to achieve sustainable growth.
In When the Money Runs Out, Stephen D. King delivers a clear-eyed analysis of Western economies and the often underwhelming aftereffects of complex policies, like quantitative easing. The book's comparison of the recent financial crisis and the Great Depression reveals significant similarities, which, if addressed, could pave the way for future economic prosperity. Furthermore, the crucial differences between these periods highlight the inherent complexities that surround the relationships among government spending, debt, and inflation. By emphasizing the importance of nominal GDP growth, the author also proposes a more prudent approach to monetary policy. Ultimately, King's work serves as a powerful reminder that sustainable economic growth is crucial to maintaining societal harmony and ensuring equitable distribution of wealth, both importantly underscored by the need to learn from past mistakes.